Welcome to this lecture on international financial management, with a specific focus on the fixed exchange rate regime, a key concept in understanding global currency stability. A fixed exchange rate regime is a monetary system in which a country pegs its currency's value to another major currency, like the US dollar, a basket of currencies, or a commodity such as gold, committing the monetary authority to maintain this rate within a narrow band. This system primarily aims to provide much needed stability in international trade and finance by significantly reducing exchange rate volatility, which can otherwise disrupt economic planning and transactions. Central banks actively maintain these fixed rates by intervening in the foreign exchange market, strategically buying or selling foreign reserves. For instance, if demand for foreign currency rises, they sell foreign currency to buy back domestic currency. They can also adjust domestic interest rates to defend the currency peg, thereby influencing the supply and demand dynamics for the domestic currency and aligning it with the pegged value. Historically, the prominent Bretton Woods system, established in 1944 and lasting until 1971, pegged major economies' currencies to the US dollar, which itself was convertible to gold at a fixed rate of $35 per ounce, aiming to prevent competitive devaluations. In the 1990s, Argentina pegged its peso to the US dollar at a 1-to-1 rate starting in 1991 to combat severe hyperinflation, but abandoned the peg in 2002 amid economic pressures, resulting in a major crisis with currency devaluation. China successfully maintained a firm peg of its renminbi to the US dollar until 2005, after which it transitioned to a managed float system, allowing controlled fluctuations within a narrow margin since 2006. Today, Hong Kong maintains a narrow band peg for its dollar to the US dollar at approximately 7.8 Hong Kong dollar per US dollar since 1983, meticulously managed by the Hong Kong Monetary Authority through adjustments in banking system liquidity. Saudi Arabia and other Gulf states, including those in the Gulf Cooperation Council, peg their currencies firmly to the US dollar, primarily due to their heavy dependence on oil exports, which are invoiced in dollars. The CFA franc zones, encompassing 14 countries in West and Central Africa, divided into West African Economic and Monetary Union and Central African Economic and Monetary Community, peg their currencies to the euro, with support from France and the European Central Bank to ensure stability. The primary advantage of a fixed exchange rate regime is enhanced stability, which effectively reduces volatility in both trade flows and investment decisions across borders. It also provides crucial predictability, which greatly enhances confidence for businesses and firms engaged in international trade and long-term planning. Furthermore, by pegging to a stable anchor currency like the euro or dollar, it helps control imported inflation and attract foreign investment, signaling prudent economic management to global markets. However, a significant drawback is the complete loss of monetary independence, preventing central banks from freely setting interest rates or pursuing independent monetary policies tailored to domestic needs. Fixed regimes are particularly vulnerable to speculative attacks from currency traders, which can lead to sudden collapses under intense market pressure, as dramatically illustrated in the 1997 Asian financial crisis, affecting multiple countries. Moreover, adjustment difficulties arise because countries cannot easily devalue their overvalued currency to restore export competitiveness and balance trade deficits. Successfully maintaining a fixed rate also demands holding substantial foreign exchange reserves to defend against pressures and potential outflows. Ultimately, the sustainability of a fixed exchange rate regime critically depends on robust economic fundamentals, ample foreign exchange reserves, and strong policy credibility from the monetary authority. Small, open economies with strong fundamentals, such as Hong Kong or certain Caribbean nations, are far more likely to maintain their pegs successfully over extended periods. Empirical factors like sustained GDP growth and high trade openness significantly reduce the probability of abandoning a peg, whereas rising unemployment and excessive government debt sharply increase the risk of collapse. In conclusion, fixed exchange rate regimes deliver valuable stability and predictability in international finance, but exact a high cost in terms of forfeited monetary independence and heightened crisis vulnerability. For finance professionals, thoroughly understanding these regimes is essential when analyzing currency risks, managing international portfolios, and navigating the complexities of global financial management. Thank you for watching our lecture on international financial management, with a specific focus on the fixed exchange rate regime. See you at the next lecture.